Good morning. So it is time for our market trends update again. Megan Aller, Nicole Ruth. There's a lot going on. That's probably too small of a statement. There's a lot going on. There's a lot going on. So I know that there's a lot of people joining us today trying to figure out what is the messaging that needs to happen for our buyers and sellers. What's the actual design of the impact, like what's happening right now that not only can I explain it, but that I can understand it and feel good about what I'm suggesting or advising to my clients. All of these things matter right now more than ever, because I'll finish my half of the conversation with some opportunities that I've been talking to people about, but there are buyers for every market and there are buyers for this market. But it's about defining how you're doing business and adjusting to the change, because you can't keep doing what you've always been doing and expect different results. You know, the saying, you get the same results. In fact, so that's the quote for this morning, that continuous improvement is better than delayed perfection. And I'm not talking about the market in that, because it's been a hurry up and wait kind of market where we finally get adjusted to what's happening and it changes again on us. This quote is about baby steps towards a new way of doing business, a new marketing idea, or maybe you're getting on video now, or you're creating your own market trends for your database. And we're always in a market where you have to redefine what's critical and important in the messaging for that market. This market isn't any more different than different markets are, but this market is painful, is what it is. And so trying to adjust to this market and explain it to your clients, take steps. You might not be an expert in video. Take the first step in doing video. I've been talking to a lot of realtors lately, and they're looking for marketing ideas, and they're looking for, how do you do video so much? And well, how can I start doing video? And I was like, you shoot one. That's how you start. You shoot one. And so it's taking those baby steps towards doing something different in this kind of market.
Well, and providing good content and good information.
So critical.
And making sure, and so I'm so thankful that you guys join us every Thursday for our market updates, so you guys are current and up to date on what the actual trends are, because I'm seeing a lot of fear-mongering posts that are out there, and I'm seeing some circulating videos that are going out from agents in the market who may or may not be paying attention to the DMARC trends, to the market trends that we put together, but they're saying that we fully shifted into a buyer's market, and that's not the case. We're definitely a lot more close to balance than what we've been in the last 2 years, but we're still only sitting at about 1.7 months worth of inventory. So we're still squarely in a seller's market.
Yes.
But we went from working at 120 degrees earlier this year to now down to about 80 degrees. And so the temperature of the market has definitely shifted, and it's just a less extreme seller's market than what we've seen before. But make sure that you're putting together good content and good information. I oftentimes have people reach out to me for their newsletters or for their content that they're posting out there, and they give me their script and they say, will you check my numbers and make sure that these are right and that I'm explaining this the right way? So if you want us to review that for you,
yes,
we're certainly happy to make sure that you've got the good content and the good information going out there.
And please do use the information that we give you, right? I mean, that's why we do it. That's why we share this content. That's why we share the slide deck, you know, and tag us. We love to have the opportunity to go in and quote. And if somebody gets negative on your positivity, don't be surprised, because there's a lot of that going on. Whenever I talk about what is good about the market and what other opportunities do exist in the market, there are people that are living in fear and want everyone else to be with them. Right?
Yes.
It's the crab in the bucket. You know the story,
Yeah.
right? Where they were trying to drag down every crab that's trying to get out. So don't get dragged down by that. Just tag us. Megan and I would love to jump in, present the facts, and then counter argue to any debate that they might want to go super negative on. So we'd love to support you in that.
One of the most common questions that I have coming up right now is, are my home values going to dip in light of a potential looming recession? And so only out of the last 9 recessions that we've been through, 2 of them did home prices dip. Otherwise, home prices remain strong. And so I do have appreciation maps that I put together by zip code for you that go back to 2008, where you can see the appreciation by zip code coming up in by quarter up until this year. And so I'll go through and I actually update that at the end of this month. So I'll be updating that at the end of this month, so that you'll see annual appreciation numbers year to date for what's been happening by zip code and kind of the overall temperature of the market. And so again, use facts, not fear, when you're guiding your clients as to how to operate in this market. I read a really interesting statistic that it's only 80% of brokers have never sold a home above a 5% interest rate.
Really?
Yes.
Really?
And so
Well, there's a
that-
lot of shock factor coming
Yeah,
in, huh?
definitely.
It's
And so how
hard.
do you navigate more
Yeah.
having these conversations about that it's still better to buy than it is to rent? And
Mhm.
it's still better to buy now, even though rates are hovering around six and a half. Because if you lock in now and rates go up to 7 or 8, you're going to be happy that you got that 6% interest rate. And again, you marry the house, you date the rate. If we go into a recession, that means that interest rates could fall and you could refinance at that point. And it's still better than your alternative of paying rent. The majority of homeowners' wealth in the United States is in your home.
It is.
And so again, it's what the best and the fastest way for you to build wealth is by home ownership and by owning real estate here in the United States.
In fact, I mean, because we'll show in the second half where rents just came out, apartment list just came out, and Zillow came out with their rents. And we're seeing that they're slowing down slightly. And a lot of that has to do with inventory in the multi-unit market. But rents are still going up. People that purchased a home, and I get right now, it might be difficult to swallow a 7% interest rate, but people that purchased a home before the first half of this year are locked in at incredibly low interest rates. They're recession and inflation proof. Their payment is not going to change. And the same goes for somebody that buys today. It takes a little bit more to swallow some of those monthly payments because I know affordability is low. But if you lock it in, you know that the rent is not going to continue to go up. Your appreciation, although slower, is going to continue to increase, right? Long term. I've got some numbers as far as what NAR is saying as far as appreciation for next year. So all of that is going to continue to be positive. Rent is going to continue to go up, and you're locking in that payment and taking advantage of the opportunity to refinance.
Real estate's a long-term game.
It is absolutely.
It's a long-term game. It's not something that it's easy to go out and make a bunch of money in just a couple of years in real estate. This is a long-term wealth building strategy that you have to keep in mind. And so when people are concerned about what's going to happen in the next year or the next 2 years, keep in mind that the average tenure of home ownership right now is about 10 years as how long someone stays in their house. They're going to have gain over that period of time,
right? And
they're going to build wealth, and rather than the alternative, like again, paying rent. Let's go ahead and hop into, we actually had a question pop up. Let's see what that question is, and then I'll hop into the slide deck. They maybe have a 3% interest rate, but they usually overpaid for the first part of the year. And so, yes, there's probably going to be some of that overpayment that happened at the beginning of the year where we were seeing homes go for $50,000, $100,000 over asking price. Right now, home prices have corrected. We're seeing more than just a seasonal transition in our pricing right now. We're seeing more of a market correction. And this goes back to the story that we were talking about last week, where home prices are down 9.9% from peak pricing strategies. And so affordability has really kicked in, and we had room for correction. Even though home prices have fallen by 9.9%, we're still up year over year for our average sales price by about 8.7%. So we certainly had room for that correction to take place in our market. And so,
I mean, anyone that purchased before this year, even if they overpaid, they are in a safe position. It's really the people that purchased the first half of this year. You know, we showed that last week when we talked about the fact that worst case scenario, if we see a 15% drop in home prices or home values, what does that do? And the majority of those buyers that could be affected and could go negative equity are all purchases this year. So you're talking about a very small fraction of all homeowners. And the trick is, don't sell. Like, I mean, that's really the whole issue. You might go negative equity for a short period of time, but as long as your payment was within your budget and you made that decision consciously and with all the information that you had at the time, then you don't really have a bad position to be in unless you sell.
Exactly. Yeah. Just don't sell. That's the key right now. Can you set up my slide deck for me? I always manage to mess it up on your computer. You've got a different setup than what I've got at my house. So
I know. I don't know why that is. All right, let's do this really quick.
Well, and it's I've got to go through an update. I just went through and updated all of my headshots on all of my graphs and websites and stuff. And now I chopped off about 10 inches of hair last week. So it's time to go through and get those all updated again with the new headshots with short hair. We're now at a bob length. So it's interesting stuff here in my world. So looking at what's been happening over the last week or so, this last week, I felt a real big lag in the marketplace just in this last week. And so as you can see, as we look at our heat sheets, tracking the inflow and the outflow of all of the business, that we continue to see a cooler transition as we get deeper into the fall months. And usually what I expect to see is active inventory starting to expire and withdraw from the market in favor of waiting to list until next spring for people that don't want to list during the holiday season. Our active inventory has actually started to go up. And so our active inventory was up week over week by about 2%. Now, it's not because we have a bunch of new listings that are hitting the market. New listings were 1,035, which is down 14.6% from the previous week and down 18.4% from the same week 1 year ago. But it's because inventory is taking longer and it's lagging and it's aging in place. It's taking longer to get properties under contract. So the active inventory is building up. Our pending transactions this week fell by 12.2%. So there was a big lag. I saw it in my title orders coming in this week, where I saw fewer units going under contract in the last week of September. And so usually what happens is our pending transaction count continues to taper off through the end of the year. And so month supply of inventory this week came in at 1.7%. It jumped by 0.2 of a month. And so we're sitting at 1.7 months worth of inventory when we look at the market overall. Now, this is the best gauge for homes that are probably around that $750,000 mark right now. That's where our average prices tend to fall right here in Metro Denver. And so this is a better indication of what's happening between 500 to $1 million. Our numbers are going to be very similar. We saw back on markets actually fall by 22.1%. I've had a ton of questions about units falling out of contract. And then if they go back under contract again, and it's still only about 8 to 10% of units go under contract and then come back out and hit the marketplace again. This coming week, the end of September is a big month for expired listings. And so I will see a big jump in expired listings falling off the market as we get at the end of September. And so again, if you're an expired farmer and you want to go out after those listings that have expired, so the end of September, October, November, and December, we continue to see more and more units expire at the end of each one of those months. So it's a good time for you to get out there and go after those expired listings. The odds of selling fell down to 49.9%, and that's the lowest that it's been all year. So that means that I take into account all of the available listings for sale versus those that go under contract and or close in the same week. And I project it forward for a 4-week period of time to try and figure out what's the likelihood of you going under contract in the next 30-day period. It's about 49.9%. And again, that's lower than what we've seen all year. And that actually takes us back to where we were in the pandemic and when we were down in quarantine. And so this looks more like what we were seeing back in 2019 when interest rates went from 3 to 4.5%. We had affordability issues come up. And so, but the odds of selling has gone down to 49.9%. If we follow historical trends from 2013 through 2021, the odds of selling tends to go down as we get through the end of the year. And so we should be seeing that number continue to slide through the end of the year. So it's getting more challenging to sell your properties. We trended closer towards balance this month, this last week, where we're now sitting at 28.1% of a market in balance, where we'd have a 6-month supply of inventory, keeping in mind that the market that's an average or a normal market, so a market in balance would have a 6-month supply of inventory. So it would take 6 months at the current rate of sales to sell off the existing inventory. We would need to have about 24,500 active units available for sale to get back to something that's more of like a normal or an average market for Metro Denver. We'd need to have about 15 to 18,000 active units available for sale. In Denver, we tend to average around 3 to 3.5 months worth of inventory, which is far short of what we would see for a balanced market. Metro Denver has always trended closer towards a seller's market than it has a buyer's market, with the exception of the Great Recession from 2008 through 2012, where we were bouncing between 6 to 8 months worth of inventory.
So we're still almost a third of what we would need.
We're still
even to
only,
be balanced for us.
We're still only at about a third of what we would need to have. And so this is again back closer to where we were for active inventory from 2013 through 2019. And so we're still short on inventory. I expect there to be, I hope to see a big purge of listings as we get into the end of the year, where people choose to expire or withdraw their listings in favor of waiting till spring to wait to list next year. That's what will really kick off our market. And so this week is going to be really telling, this next weekend, to see how many expired listings hit the market coming on tomorrow. Usually the last day of the month is where we see a bunch of expired listings pop through.
So we're still near the top of where we've been. Looking at your chart, chart, we're still near the top of where we've been all year on inventory though.
Mhm.
It's starting to
Yes.
creep back up as buyers are slowing down.
Yep.
And even with the new listings slowing down,
Mhm.
the active listings are sitting on longer.
Yes, they're sitting on longer, bumping up our
Yep.
active inventory. Showings really slowed this last week. They slowed by 9.1% over where we were the week previously, and they're down 45.6% from where we were the same week 1 year ago. We set about 12,000 total showings in the last week, and that's about 1.8 shows per property per week. So 2 shows per property per week. So it's been tricky trying to figure out when you should be making a price adjustment. We knew very squarely at the very beginning of this year, when our median days on market was 4, that if you weren't under contract by the first weekend, that you likely had a pricing problem.
Right.
And so now it's, you've got to slow down the rate at which you're making price reductions. And by watching what's happening with your showings, this is a really good time for you to take that second breath and wait and see how many showings you're getting on a weekly basis. I'm still fielding a lot of Monday phone calls for how many showings were set in my zip code at my price point. Feel free to reach out to me for that report. I'm happy to pull it for you so that you can see how many showings you got over the weekend. And if you fell into the normal or average for what you should be getting for that zip code, I'm certainly happy to look at that for you. It's really hard to run that by subdivision because it depends on what the listing agent decided to put in as the subdivision name.
Right.
So is it Wash Park? Is it Washington Park? Is it Wash PK? And so looking at it by zip code and by price range is a much better way to go through and look at that to make sure that you're getting all of the correct information out. And so give me a call on those on Mondays. I'm fielding a ton of those calls right now. I'm happy to answer those calls for
I'm
you.
really surprised there's not a drop down list for that or something.
I know.
You'd think you'd want consistency of data.
Yeah, they're kind of, subdivisions are nebulous. Like they
Yeah.
don't really have finite boundaries. And so they kind of shift and change, and it's funky how they're input into the MLS system. But about 1.8 shows per property per week. So if you didn't get 2 showings on your property last week, that could be indication number 1 that you might need to be in a price reduction zone. The next one is 13 showings to yield a contract. And so buyers are actually looking at 1 more home per week. Based off of data from this week, we've been bouncing between 12 to 13 showings should yield you a contract. So wait until you've had those 12 or 13 showings before you go through and make a price reduction. Because again, it's taking longer to get people through these houses before you go through and make that price reduction. Median days on market held at 17. Median days on market has actually been coming down for the last 4 weeks. We peaked out over Labor Day weekend where we had 20 median days on market. Now it's down to 17. Usually days on market continues to stretch out as we go into the later part of the year. So expect that number to rise as we get into October, November, and December, but it was half of the homes were under contract in 17 days. So that could be indication number 3 that you need to make a price reduction is if you've been on the market for longer than 17 days. Based off of data that went under contract last week, it was 47.7% of all the listings that went under contract last week made at least 1 price reduction. 51% made no price reduction. And interestingly enough, 1.2% made a price increase. Which is an interesting strategy. Sometimes what happens when I see those price increases is, whoops, I forgot to add the extra zeros when I entered in that original list price. And so sometimes I see that happen where we see price increases where it comes back on, it's their current price being 3 zeros more. And so oftentimes I can go through and make those manual corrections if it's a pretty obvious one. Otherwise, I just kick that data out because I'm just not sure what their original list price was meant to be. But again, we ended up seeing that it was 47.7% of them made price decreases. Average price decrease was about 6.5%. I've had a lot of questions lately about, well, do I make a price reduction? Do I make a seller concession?
Yes.
What's my strategy? And so based off of data from last month for homes between $400,000 and $800,000, it was 50% of them that sold in the month of August ended up having a seller concession, and the average concession was $5,500. And out of those it's out of those ones that offered concessions, 50% of them also had a price reduction. And so in some cases, you may be offering both a price decrease and a seller concession. And so the way that you want to do that is make the price decrease, and then within the public remarks field, include that you're going to offer a seller's concession. We can help you work up net sheets on that for you too. If you're going to offer a seller concession and you're working with First American Title and you want a seller's net sheet, we can run multiple scenarios for you. So reach out to me or reach out to your closing team in order to get those seller's net sheets so that we can run those scenarios for you. But it was a 6.5% price reduction. I've also had a lot of questions about, well, do I make a series of smaller price reductions or do I make one bigger price reduction to get back in the market? And I'm a fan of going with a bigger price reduction up front. in order to get it down a searching tier, because the way that people search the MLS system, they search from 2 to 300,000 or 300 to 400,000. And so you need to get it into another $100,000 bracket or another $50,000 bracket in order to make a significant enough price reduction that you're getting it into that next searching tier, so that you're opening it up so that you can see. And again, that showing report that I use on showing time, I go into reports, target market analysis, and it's called reports, target market analysis is the name of the report that I use. But you can actually see by price range which price bracket is getting the most number of showings. So that could be another tool in your tool belt to see if a price reduction is warranted or not, to see if you're going to get more showings at a lower price point or not. So that's a great report to have. You have to
say that report again.
So it's in showing time. You go to reports and you go to target market analysis, and you can do by zip code and price range.
Got it.
And then you can see if you're getting more showing activity at lower price points.
Gold nugget right there.
Yep, there you go. Looking at the under $500,000 market, this market also continued to cool as we got deeper into the fall. We're sitting at 1 month worth of inventory. We've been hovering around 1 month of inventory now for about 4 to 6 weeks. Our average daily active count came up by about 3.7%. Pending transactions went up by about 2.3%. So a little bit more activity in the under $500,000 market. Odds of selling is 61.3% in the under $500,000 market. We still only have 16.5% of the inventory required to offset demand in this particular market. We're getting about 2.5 shows per property per week. Showings slowed down in this market as well by about 5.4%, down to 4,400 total showings that were set for homes that were under $500,000. We're looking at about 11 showings to go under contract right now. So if you're getting about 3 or 2 shows per property per week, 2.5, and you get 11 shows to go under contract, it could take 5 weeks to get enough people through that house before you decide to make a price reduction. Median days on market slid up just half a day. It was at 15.5 median days on market for units that went under contract this last week. 45.2% of them made price reductions, with an average price reduction of about 6.3% for homes that were under 500,000. 500 to $1 million, we're looking at that market really slowing down. Again, this is our most interest rate sensitive bracket, where about 90% of the people that are purchasing between 500 to $1 million are using some sort of financing in order to get into these properties. Our average daily active count came up by 1.9. Pending transaction count fell by 15.9% this last week. So this market really slowed down in terms of what units were going under contract. And we jumped from 1.6 months worth of inventory up to 2 months worth of inventory. And again, that's the highest levels that we've seen since we were back here in quarantine. And so that means that for every one buyer at the market, they have roughly 2 homes to choose from. So this market has slowed down. It's still considered to be an extreme seller's market with less than 3 months worth of inventory. And so that's still back on pace with where we were back in 2019 before the pandemic hit. The odds of selling slid down to 46.5%. It fell week over week by about 4.1%. So the odds of going under contract this last weekend slid by about 5%. In this market, we're now sitting at 33.2% of a balanced market. So we're up to 1/3 of where we should be. We should still have about 12,700 active listings in this market to get to a point of balance, but this market is the closest one to getting to a market in balance, or getting closer to that average or normal active count that we would see in this market. We have 1.5 shows per property per week, 13 showings to go under contract. So again, it's taking longer, and they're looking at more houses before they go under contract. Median days on market actually slid a little bit. We actually went from 21 median days on market to 19 median days on market. So days on market actually came down. So that could be strike 3 if you need to make a price reduction. More than half of the homes that went under contract last week had at least one price reduction. And the 51.4% of them made price reductions last week, with an average price reduction of about 6.3%, or about $46,000 off of the original asking price. Homes between $1 to $1.5 million. The cooling trend is also set in. We had one of our cooler weeks that happened as we went into the last week of September. Month supply of inventory shot up from 1.6 months worth of inventory to 2.6 months worth of inventory. So that happened in just 1 week. We'll see what happens when we have a bunch of listings expire coming into this next week, if that month supply of inventory comes back down or not. But we have about 2.6 homes available per buyer in the marketplace. Pending transactions this last week slid by about 40%, where we only put 48 units under contract that were between 1 and 1.5 million. Average daily active count came down by 1.6%. So we have about 545 active listings.
I wonder how many of these people, so these are new listings, more active inventory coming on the market, or is it just
So this is
active
active
staying?
inventory that's staying and aging in place.
It's staying and aging. It's not new
Staying
listings.
and aging. And
Okay.
so new listings were
So just
down by
checking.
1.2%. Looking at our odds of selling for 1 to 1.5 million, we were at 43.2% odds of selling. That number is held relatively consistent for the last 4 weeks or so. We're now at 29% of balance in this market. That number also shot up. We were only sitting at about 17% of balance last week, so it shot way up by 11% this last week. We're up 19.2% from where we were 1 year ago. Looking at shows per week per property, we're looking at about 1.7 shows per property per week. And it was 19 showings to go under contract. So people are really starting to take their time as they look at these homes between 1 to 1.5 million. We'll see if this week is just a blip or if this is going to be a continued cooling trend as we get into the rest of the year. Again, I'm really looking for this big purge of expired listings at the end of September. 16 median days on market for homes that went under contract last week. Looking at 36% of them made price reductions. We're seeing fewer price reductions in the $1 to $1.5 million price point, but they're large price reductions. 11.1% price reduction, or $175,000 off of the original asking price for homes between 1 to 1.5 million. Last section that we'll talk about is 1.5 to 2 million. Cooling trend continued to settle in, not quite as much as when kids went back to school, but things have cooled off pretty substantially. We went from 2 months worth of inventory up to 3.3 months worth of inventory. We only put 14 units under contract in this market this last week. That's a decline of about 40% over the previous week. Our average daily active count held fast at 200, so there was no change there. New listings, only 27 new listings came on the market between 1.5 to 2 million, so that was down by about 34%. So the reason why this shifted so much was because we put fewer units under contract between 1.5 to $2 million. The odds of selling slipped down to 35.1% odds of selling in the next 30-day period. We're looking at about 27.4% of the inventory required to offset demand right now. So again, this market has started to trend towards closer towards a market in balance along with the rest of the market. So we're looking at about a third of the inventory that we need to offset demand right now at most price points. We got about 1.5 shows per property per week in the 1.5 to $2 million range, and it was 20 showings to go under contract. So again, a lot more showings to go under contract this week than what we were seeing in previous weeks. That's up by about 52% from where we were this last week. Median days on market was 12. So this tells me that since median days on market is still staying relatively low, that's actually our lowest price point, or our lowest number for all the prices that we're looking at is 12 median days on market. It's even lower than the under $500,000 market. That there's a pool of active potential buyers that are out there that are looking between 1.5 to 2 million that have seen everything that meets their criteria on the market, and they're just waiting for those new listings to hit the market and snapping those up. And so if you've got a really great house that's between 1.5 to $2 million right now, you've got it priced well, you've got it staged, you've got fantastic photos and a great listing description, that those are still likely to go under contract fairly quickly, and it's still less than 2 weeks for those homes that are between 1.5 to 2 million. Only 28.6% of them reduced their price, so we're seeing the least amount of price reductions in this particular price range, but the price reductions that we did see were large. They were 13.4%, or about $277,000 off of their original asking price. So large price reductions that we're seeing in that particular price range right now. We had some questions pop up, so let's go ahead and answer some of those. Let's see, can you repeat the percentage of agents who have not worked in a market where interest rates were over 5%? So the stat that I read, and it was an NAR stat, was 80% of agents have never sold a home over a 5% interest rate. From Erminio, those who purchased early in the year didn't lose anything, especially if they purchased under 4%. They were able to purchase more home at a lower payment, and in their preferred neighborhood, they could purchase now. I would agree with that statement because if they were able to lock in at a lower interest rate, they're probably pretty happy that they were able to do that. So yes, they were purchasing, it was their long-term gain over the amount of the lifetime of that loan, and the amount of interest that they would pay is substantially lower now than if they would have purchased it 6%.
But they probably paid for over asking.
Yes, they probably paid for over asking.
And that's the debate.
Yes.
Yeah.
I received an email this week from RE Colorado letting me know that because my broker just launched Broker Bay starting October 12th, I will no longer be able to list showing time as my showing service in RE Colorado. Will this switch to Broker Bay impact your showing data? Right now, it's about 10% of all the listings are Oh, no.
Don't just close out that.
Okay.
That's
So
weird.
right now it's about 10% of all the listings are in Broker Bay. Broker Bay is really challenging for me to try and extract data from. It takes me 35 searches to get one number because I have to separate it by price range and by county, and I can only run a set number of counties each search.
Mhm.
And so it's really painful for me to try and get that out. So you could bump up my showing numbers by about 10%, and that will get it. Are there any numbers on how many days on market after a price reduction is made? I can't tell when the price reduction was made. I can only tell if price reductions were made. And so I don't know exactly how many. That's why I go by the 3-strike rule, where if you're not getting 2 showings per week, if you had a total of 13 showings and no offers, or if you've been on the market longer than 17 days, then it's time to go through and make a price reduction. But I don't have a date as to when the price reduction was made. If I had a price reduction date, I could go through and compare that to when it was listed versus when the price reduction was made, but I don't have, that's not a field that I can extract from the MLS.
You would think it would be. It's certainly a field that's being tracked, or at least being recorded,
Yes.
but not reported on.
Yeah, but it's
That you
not,
can't,
it's not a
feel
field
like-
that I can extract, that I can actually look at. So the report that I was talking about in showing time, a question on where to find that is if you log into your showing time account, you go into reports and target market analysis, then that is where I go through and get that zip code report, but you have to have the upgraded showing time report in order to get that report out of there. So there's all of our questions. We'll have Nicole go through and kick it off and give us our weekly update for what's been happening in the marketplace.
Absolutely. So, and definitely, I know you guys are hearing a lot, right? You've got stressed out buyers, sellers. So please do continue to ask any questions in the Q&A section. We'll make sure to get to those. There's not a whole lot of economic data that happened this week. I'm going to go through what did happen so that you know what the talking points are. But as far as big moves, it was all in the interest rates, and which is probably bigger than anything else. And all of the moves because of the interest rates were due to things that were happening overseas, not even here. So I'm going to share with you the economic news that did come out this week. It didn't move the markets. None of it did. We had the GDP come out today, and that was as expected. We've got mortgage purchase applications. We had some construction data and new or pending home sales. So we'll go through that. But first, I want to talk about what's going on in what happened in the interest rates. So I'm going to share my screen. All right. So again, baby steps, taking those motions towards not only educating yourself, but using the marketing opportunities that Megan and I talk about on a constant basis, and that there's so many resources to be in front of your clients. Right now, the worst thing you can be is irrelevant. What you want to keep doing is creating content that means something to your clients so that when they're ready to make a move, you can't pressure them in a time like this. Fear is too strong, but there are buyers for every kind of market. So you just need, your primary job is to stay relevant, stay on top of the news, and communicate that information in a way that they can absorb it and take action on it when they're ready. So just making those small improvements is a huge benefit. All right. So, and today's the 29th, not the 28th. I did that obviously last night. So the 30-year fixed mortgage rate. So what's going on there? So I blocked out what has been happening in September alone. That's the square. So we moved from 6% to 7%, now down to 6.5, 6.625. And today it's moving slightly higher, and we've been doing a ton of volatility. So what happened just in the last 4 days? I don't want to even go back to the beginning of the month because that could take me a while. But we've had a lot of volatility. We've seen the interest rates go up. That interest rate going up a full percentage point obviously makes a really big difference, especially when it happens on Thursdays, because you're trying to take your clients out, which it did this past weekend, which is maybe why it was a little bit slower, because we had that huge spike on Thursday. And all of a sudden, what I could afford because it was at the top of my market, because prices have been going up, I can't, because I had been pre-approved at this percentage rate, and now it's this more expensive interest rate. So what happened on Thursday? Thursday, Switzerland raised their central bank rate by 0.75%. They matched our Fed with their raise, but they've been pretty slow at doing that. So them raising their Fed rate or their central bank rate pushed over into our markets and created a bond sell-off. Then on Monday, the EU, the European Union, now you gave it to me.
I know, I had the stutters today. I don't think I've had enough coffee.
I don't think I have either. I'm only on coffee 2. I need at least 3. But then the European Union also had a massive bond sell-off on Monday. We saw that, and I'm going to show it to you in the bonds in just a second. So that happened, and that's what spiked our rates up over 7%. On Tuesday, the Bank of England then stepped in and had an emergency bond selling. So they scooped up some of their bonds, because remember, now the Fed doesn't buy mortgage-backed securities anymore. So all of this volatility is really based on the fact that the market is driving the bond market. The Fed, which was the biggest buyer of mortgage-backed securities, is no longer buying mortgage-backed securities to stabilize the market. And I'm going to talk about that in a minute as well, a little bit more. And then last night, overnight, which is why we've seen a little bit of a tick up in interest rates today, is because Germany had a record high inflation number. All of those things are outside of our control and outside of our borders, yet they're impacting the bond sell-off here in the United States, especially with how strong our dollar is right now. So if I go over and box out the same period of time, the September 1st through today, we lost 416 bips. So this is a drop from where the 30-year, so now I'm looking at the bond pricing. And when bond pricing goes down, yields go up. And our interest rate on a bond or on a 30-year fixed mortgage is a yield. So that yield is going up while bond prices are going down. They have an inverse relationship. So when I'm seeing this go down, it's not good for me. It's when interest rates are going up. And we saw it move from 100.72 all the way down to 96.5. That's a massive movement, a movement that you don't see over 400 bips in a single month period. It's that velocity and that volatility that's creating an instability with investors. Now, remember, just like stocks, bonds need buyers. So if you don't have investors who are buying at these higher interest rates, you have more volatility because you have less of a buyer pool, making them move as erratically as they're doing right now. So there's not a lot of buyers who want a bond, even though theoretically, a bond that's pricing out at this kind of pricing should bring more buyers in because it's giving me a better yield over the long run. But everybody believes, and I don't disagree, that all of these bonds will be refinanced. They'll be gone out of your portfolio in the next 6 to 18 months. And if I'm buying a bond, a long-term bond, a 5-year or 10-year bond, I'm expecting to hold on to that bond as part of my diversified portfolio. And now that bond is sold. We're definitely seeing that on the 2-1 and the 3-2-1 buy downs as well, because investors believe those buyers will get out of that mortgage as quickly as possible so that they can lock in a lower interest rate, because really they're just temporarily buying themselves into a lower position, hoping, as we all are, that the interest rates will go down and they can refinance. So there's not a lot of market for the 2-1, 3-2-1 buy downs from an investor perspective, nor is there for a lot of these higher priced interest rate bonds. So we saw 155 bips movement just in Monday alone. And I wanted to kind of show you this so you kind of see what am I talking about when I'm talking about bips? Because inversely, it affects the interest rates. We kind of saw that. They jump up in relationship to the bond moving. So it's the bond prices that are impacting the yields, which we in turn look at as interest rates. So I wanted to show this little clip right here of this drop. This is what it looked like longer term. So I just zoomed out and I'm like, we were in a really happy place for a long time. The happy place is gone. And now we're just sad. And we're sad because those bond prices are dropping. A lot of volatility. So you're seeing some, movement in here where it's green, it backs up, it rubber bands a little bit. It's that shock factor. We get used to it and then it changes again. But this movement has created a lot of that instability market. That secondary market is creating the volatility with the interest rates we're feeling since the Fed is no longer buying mortgage-backed securities. So I wanted to kind of give some scope to why we were seeing such volatility. It really is until the Fed finishes raising up its Fed rate, starts to create stability, even gets back into the market of buying some of the mortgage-backed securities, we will see some of that stability come back. Or even if they finish raising the Fed rate and then the interest rates drop, where it's sustainable for a period of time. And maybe that's 4.5 or 5%. It really is. And I've said this a number of times. It all depends on what it's dropping from. If it's dropping from 7 or 8, it could look a little different than if it was dropping from 5 or 5.5. So when that hits stable again, more investors will come in and start loading up their portfolios with those interest rates, those yields to hit their diversification quotas. So NAR's Chief Economist Lawrence Yun, the direction of mortgage rates, upwards or downwards, is the prime mover for home buying, and decade high rates have cut deeply into contract signing. If mortgage rates moderate and the economy continues adding jobs, then home buying should also stabilize. I want to wish for the same thing. I want to wish for the same thing. So let's talk a little bit about what he's talking about. So contract signings, that quote came out after the pending home sales index was released, dropping 2%. Now, 2%, that was actually right in line with expectations. So we're seeing that locally, we're seeing it nationwide. Some of it is seasonality. Some of it is the fact that sellers aren't selling. We've got a seller strike. They're sitting in a position where they don't have to, they don't want to, and they're not. I'm just going to take my ball and go home. So that's what we're seeing. It dropped 2%, really quite in line and not unexpected considering most sellers are buyers and many of those buyers are in the same market. So they have to determine when that timing is right for them. I mean, if they're selling here and they're going and buying in Iowa, they got a pretty good deal going right now.
Yeah, they sure do.
Yeah, especially right now, if they can get in before Halloween, probably, and then we're going to start seeing some of that buyer slowdown. Not that we're not already seeing some buyer slowdown, but you saw some of those price points picking up. New home sales contracts, signed contracts also came out this week. And I wanted to highlight a couple of these numbers because at first it looked really good. Annual sales pace went up 29% month over month. That's a huge jump from an annualized 530 to 685 units sold over the period of a year. They annualize that. But this is like we're working off of record lows. More typically, we see 1.4 million new homes sold. So to see a 29% increase off of a record low, this is kind of the same numbers that we were seeing when we're seeing desperately low inventory, but we see a 20% increase because it went from 1,000 to whatever,
so
6,000.
Yeah.
So that's when you've got smaller numbers, you're going to have bigger percentages. So to see the 29, this isn't necessarily a celebration. When you dig into that, so they say that we've got 8.1 months of inventory. When you actually look at the monthly sales pace and you look at how many homes were completed, 49,000, that's not a lot. When you're talking about nationwide, you've really only got 0.86 months of inventory that is actually available to move in, to close, to sell. The rest of it is all under construction. In fact, a record high of 1.86 million months of inventory, 1.86 months of inventory hasn't even started yet. So those are just builders that are waiting to see what happens with rates before they put a lot of money into building those homes. Maybe those buyers have already backed out, or maybe they don't have buyers for it yet, but they're certainly waiting to see when those interest rates start to settle to bring them out. Housing starts were down primarily for 1 units. So we kind of see this is starting to tick down. It's been coming up. So that's not wholly surprising, but the housing starts for multi-unit is still on a high trajectory. That is going to satisfy some of the rental increases that we've been seeing. In fact, Zillow came out at 12.3% and Apartment List just came out at 7.5%. That's down. That was 10% last month. So it's still up. It's still costing people more to renew. It's just costing people less more to renew, right?
Yes.
That's probably not the right way to say that.
That's exactly how I would have said that.
Yeah. It's just less more. So this is going to continue to start to normalize. I mean, if you look at historic normals for rent, when I do a rent analysis, or when I'm looking at somebody who's helping to invest in real estate and we're running their numbers, many times I'll use a 1% annual increase in rent. And I can make good money long-term with appreciation, principal reduction, and a 1% rental increase. I don't need it to be 7.5, and nobody really needs it to be 7.5 for any length of time because it's not healthy. It's strangling out the rental market, which is why home ownership is still the stability. as long as it works, right? I'm not saying everybody's a buyer right now, because not everybody is. Some buyers don't have the stability of a job. They don't know if their job is going to be stable, or they don't have enough in reserves. You certainly shouldn't be spending all of your reserve money to buy a house right now, not knowing what next year will bring. So if you don't have extra in reserves, if you don't have a full stability or feeling about your job security, I wouldn't buy right now. Or if you are planning on moving quickly and you don't want to hold that home as a rental. I was having a conversation with an interviewer, and they were asking me, well, who shouldn't buy? And those are really, if you're planning on moving short term, you're not going to make your money back, not in a market like this, unless you're going to hold on to it as a rental. Or if you deplete all of your reserves, it's not safe. And that makes sense. All right. So NARs, Lawrence Union again. So we expect existing home sales to decline 15.2% in units sold, right, over 2022 to 5.19 million units total for the year, United States wide, while new homes are projected to fall by 21%. However, due to limited inventory and non-existent distressed property sales, home prices will still rise, United States, to almost 10%. So that's still really strong, right? But it's coming down from unhealthy high double digits.
Yes.
So this is that period of the slowdown, right? It's a deceleration. It's not losing value. It's slowing down the appreciation. They also go on to forecast 2023. Now, of course, everybody's forecasting right about now. They go on to forecast next year, the annual median home price is expected to rise by 1.2%. Remember, 2019 was barely over 2%. This is not an awful number. It is still positive, and it's still strong long-term. Home sales will pick up in the second half of 2023, but will be down 7.1% overall. So as you're budgeting, as you're figuring out what your sales goals are for 2023, recognize that the first half of 2023 will look different than the second half of 2023. And we just pushed out our Agent Ignite for next month. I haven't even told you yet.
Oh God, what are we doing? So excited.
I know, right? So it's not October, it's November. And it is 3 hours. So you got to budget for the time. And we're doing it at Combine Country Club again. So from 10 to 11, we're going to do our market update.
Okay.
And then from 11 to 1, we have 2 hours in there. And of course, we'll feed you, is goal setting.
Awesome.
Right?
Perfect.
Well, it's
the time of year to do your goal setting.
Yes. And so we're going to be doing that in November before the holidays, keeping these things in mind. How are you stretching yourself? How are you doing things a little bit differently to assimilate to the changing market and the communications that your buyers and sellers need? So right now couldn't be more important than to identify some opportunities that you can bring into play in 2023 to continue to be relevant. Home price growth slow. This was all over the headlines that it slowed by a record amount. The brakes are getting pumped, right? So, but it's still up. This is CoreLogic. And I'm sorry, this is Case-Shiller. Case-Shiller and CoreLogic are related. So this is Case-Shiller, but it's still up 15.8%. Now, this was July, and we know that we saw a lot of shifting in August. So this isn't even accounting for that. So we're probably going to have another drop that is the by record amount next month. So know that that's coming and be able to speak into it. But it did drop down. It dropped down from 15.8. It dropped from 18.1. So that was a significant drop, which is affecting affordability. So affordability, not specifically the drop, but the high prices from which they're dropping and the high interest rates. So Calculated Risk blog is one of the blogs that I read, and we had a conversation via email about this morning. So talking about, thank you, Laura, for having that conversation with us, but talking about realistically the affordability feeling today versus how long ago. So I actually pointed an arrow. So you've got to go back to 2007 to get the same feeling of affordability based on home prices, based on inflation. It's inflation adjusted affordability, and then based on interest rates using a 15% down calculation and Freddie Mac interest rates. So that kind of affordability, people are feeling it. You can't dismiss that. And we don't even try to pretend that it's not unaffordable. But the question is how long and what is your projected plan for this home? Because if you're not investing in home ownership or real estate, what are you investing in? I mean, there's not a lot of safety in the stock market, and there's certainly not a lot of safety in Bitcoin, and you don't want to be sitting pigeonholed for very long. Now, a lot of people are going to cash right now, and I understand that. But if you have the opportunity to push forward, to actually invest in opportunities, this kind of market actually brings opportunities to light for those people who are working outside of the fear. Fed Chair Jerome Powell was quoted saying, for the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, right? To get that affordability back in check. And while we're raising the Fed rate and the interest rates to control inflation, once inflation is controlled, we will see that come back. And here, right, we talked about this last week. We're expecting that to happen in October, right? So you guys start watching that. October through the end of the year, through January or February, we had a block of time where inflation was really high last year. That year-over-year comparison is going to start coming down. When we see inflation coming down, we'll see the Fed start to react to that. We'll see the Fed rate starting to stabilize, and we'll also see interest rates starting to come back down. Again, the opportunity for refinancing. But so he goes on to say, so we needed to get better in line so that home prices come back at a reasonable level and that people can afford home prices again. And I think we should probably be in the housing market needing to go through a correction to get back to that place, right? So he's been talking about pain. He's been talking about correction. He's been talking about the fact that we need to slam on the brakes of demand. So that's happening, not slamming on the brakes, but it is continuing to happen. So mortgage purchase applications were down again, 1% week over week. And outside of COVID, I've got to go back to 2016, the end of 2015, to get this index level of mortgage purchase applications. So, and this is just purchases, not even refinance. If I add in refinance there, it's even worse. So don't do that. This is just purchase. This is what you and I do, right? Not the refinances. But it is still, we're seeing affordability going back years. We're seeing mortgage purchase applications going back years. You are looking at the inventory. You're looking at all of your indicators going back years. So we have to realign with where our goals are, but we're still not losing significant amounts of value. We're readdressing those who may be overpaid, especially at the beginning of this year, and we're correcting sellers' expectations, right? That unrealized gain versus seeing home prices drop. Active inventory nationwide, and we saw that here, which is why I asked that question of Megan when she was talking about the inventory for the Denver market, is active inventory just hit a high for 2022. We're still under 2% from 2020 and 42% from 2019. And here locally, we're down similar numbers from 2019. But this number is what Powell has been asking for. It's exactly what he was talking about in the last Fed meeting minutes, is the fact that we need to slow down demand, check. We need to raise inventory, check, to get housing in a better balance, right? So at least we know that this is headed to where, so as long as he's looking forward and not completely looking at metrics that are starting to get dated, which he tends to do, then he's going to start seeing that we might not need all the Fed rate increases that he has in mind. But what he doesn't want to do is come right back down again, only to have to go back up again. So it is going to be up and then it's going to be sustainable. I'm just hoping that if some of this comes to light, that he doesn't go all the way up to a Fed rate of 4.5, that he can pull back before then and then hold it for a period of time, allowing our market to adjust, allowing inflation to go down, and then the interest rates will then go down. Because this active inventory, while it's good for 2022, is still low. And it's that perspective that we don't have a housing bubble situation. We have a slowdown of home prices. You can't bubble what's not there. People aren't selling because they don't need to. They're turning towards new builds because they're available. And we've got some new builds coming on the market, finally getting completed, but they're not solving our problems. Certainly not when they're half of a traditional coming to market year over year. So if the new builds are only half of what they typically are, and our active inventory is a fraction of what it needs to be, then we're not going to see people go into foreclosure status. But there are opportunities, and I've been talking with a lot of realtors about how do you find the pre-foreclosures? How do you help them through the options? All right, because ultimately they're just going to sell. So are you there helping them work through that? Jobless claims came out low again. Literally the lowest level since April. People are not staying unemployed. if people are being laid off, they are going and finding other jobs. We really, and I hate to say this because it means pain, we need to see the unemployment numbers, which will come out next Friday, actually start to go up, which means some people are getting a loss of jobs, which allows the Fed to know that they're starting to attack inflation, and it's simply not happening. But I go back to this conversation, and I kind of want to start to land the plane here, is that there is a buyer for every market. It is about education and awareness. It's about their ability to consider all the facts and not be caught up in the headlines and then make that decision. I mean, just this morning, Megan and I were talking about the fact that I had 2 phone calls and a text all looking for opportunities. One is buying land and 2 are buying investments. And they're all putting in applications to get going right now because they've spotted something that they want to put in an offer. There are still buyers for this market. They're looking long term. They're not looking to fix and flip it. They're not looking to buy it and then sell it in the year. They're looking for opportunities that they get a little lower in price. They can get all the seller concessions that they need for all the inspection repair items, and they can put themselves in a rental situation where cash flows. And I had a conversation with I don't know what he was, maybe 32 years old. And he was asking me, he goes, but I can't cash flow. He goes, why are we looking at investing? Because we were talking about it and he wanted to do it, but he was hesitant. And he goes, I feel conflicted because I can't cash flow right now. And I said, well, are you net positive? Like, are you breaking even? He goes, I can break even on some of the things I've been looking at, but I'm not producing cash. And I said, you're 32, you're still young. How long are you going to hold this? Over time, we're going to see long-term appreciation. You're going to get the benefit of principal reduction and you didn't do it. And then we will go back to normal appreciation levels where in 30 years, you're going to have 1, 2, 3 homes fully paid off, double or triple the value that you bought them for with the opportunity for rental income, right?
Yep.
You have to put the realistic picture on what's happening today, and there's still opportunities and there's still buyers for this. But it also is super important to align yourself with somebody like Megan, with myself, somebody that you know has education at their core that wants to work with clients and not put them into a transaction that might cause them more harm than good. I also had another conversation that I don't want to go too knee deep into, but it was awful. Some of the things that she was told to do, did do, and now at age 62 has limited options based on her moving some money into self-directed IRAs, wanting to Airbnb it. You can't Airbnb self-directed IRAs, and not getting to that position where at age 62, she has to make some very strategic decisions, but having spent a lot of money on an investment program was limited in the options that she had. So surrounding our people with education and helping them find the path is what is so important right now, because there's a lot of people, because they don't have enough business, are starting to feed on some people that they shouldn't be. We have to protect our clients and our database against some misinformation. And with all of that, we just talked about, we sent out the Wednesday video talking about the construction loans, the 1 and 2 time closes, the lot loans and land loans, interest only for 24 months. That's the conversations I was having via text this morning, moving those loans into construction. We are having a lot of conversations with people, helping them either subdivide multi-units, build scrape properties. I just had somebody send me a lot inner city that they could be scraped and they could build up to, I think, a 4-unit. I mean, all of these things are happening and they're all being talked about right now. Having the tools available to be able to use it is key. And then we also just created this weekend. I sat down, I had 3 agents ask me, how do I calculate a 2-1 buy down amount? We're going to send out this Excel spreadsheet that I created over the weekend to simplify. This is the amount you need. You plug in the purchase price, you plug in an estimated down payment from the buyer, what the current interest rates are, and it will tell you exactly what you need to do a 2-1 or a 3-2-1 buy down.
Awesome.
All right. 2 questions. Can't wait for November Ignite. I'm super excited, Ms.
Super
Dawn.
fun.
Steven, that one's yours. Megan, besides seeing a seasonal price adjustment taking place in the Denver market, do you believe we are seeing a price correction happening, especially considering the amount and size of our price reductions?
Yes, I do believe that we're seeing more a correction for affordability than we are seeing seasonal adjustments. Historically, what happens is between the months of June, July, August, and September, home prices tend to fall 3 to 5%. We're down 9.9% right now from peak pricing back in April. So there's definitely more of a correction that's happening here outside of what we seasonally see for our retraction.
And somebody just asked for this spreadsheet again, and I will send this spreadsheet out with our email that we put everybody on. Thank you so much. You'll be there until you push yourself off. And then what day is the November Age and Ignite? It is usually the third Thursday, which I'm really hoping is the Thursday right before Thanksgiving. You guys are testing me. That will be on the email as well. Yes, the 17th, because Thanksgiving is the 24th. So that will be on November 17th. Important to consider when pricing a home to put it on the market, says Stephen. So that's a wrap. We did it with a minute to spare.
Awesome. You guys get recess early today. That's awesome.
Well, thank you guys so much for joining us. We always enjoy putting this together for you because we know how powerful communication and messaging is right now. If there's anything we can do, whether it's Megan Eller or myself, Nicole Ruth, we would love to go to work for you and your clients, helping them find success in home ownership, because I know we both believe at our core that that is the way to build real wealth, and it's through real estate.
Awesome. Thanks so much for joining us, guys. We certainly hope that if we're able to help you better advise your buyers and sellers, that we'll get to meet them at our closing table. So please keep Nicole and myself in mind for your upcoming client opportunities. We'd love to work with them. Feel free to reach out, and we will see you guys. I'll be sending out the invites for the October meetings in the email today so that you guys can register for October market updates, and we'll see you guys soon. Bye. Thanks. Bye.